following presentation is for educational purposes only. All the symbols, trading ideas, and market commentary are for educational and demonstrational purposes only and are not recommendations or trading advice. Live sample trading occurs in a simulated environment. Past performance may not be indicative of future results. All the information and content presented is provided by NinjaTrader LLC, and the opinions expressed by all third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involves substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.
Well, happy day after Thanksgiving, everyone. While you're relaxing and recovering from all the turkey and pumpkin pie, we've got a special treat for you today. For the holiday, we're going to hit pause on our usual live stream broadcast and bring you an exclusive lineup of videos related to our strategy trading series that Tom and I have done. So strategy trading is more than just a way to trade. It's a way of thinking about setups and trading styles. It's a way to sharpen your discipline, follow your trading plan, and even more than that, it helps you truly understand the market. Strategy trading is definitely a positive step in any trader's evolution and journey. And it's, as I said, it's all about taking emotion out of your trading. In this special series, we will start with an overview of the foundations of what strategy trading is. And then the second episode will be all the different building blocks of a trading strategy, how to put a strategy together, entries and exits, risk management. The third video will be on strategy performance, historical evaluation of a trading idea, and all the different elements that go into determining whether a strategy has a good chance to perform well moving forward. And then we will talk about strategy optimization, a way of refining your strategy, adjusting input parameters in a very efficient way where you can look at a number of scenarios by using the strategy analyzer. That's a feature within the NinjaTrader platform. And then finally, in session 5, we'll talk about strategy automation, the ability to trade hands-free, really taking all of the decisions out of your hands and putting them into the program based on your rules, based on your entries and exits. So, whether you're still, enjoying those leftovers from yesterday's, or you just need a quiet moment to get your fix on trading today, just sit back and relax and enjoy these 5 strategy trading sessions. Thanks, everybody. Welcome back, everybody. My name is Michael Burke, and today we are kicking off a brand new series of educational events around foundational strategy development and trading. This live stream course is a group of segments. We probably have 6 or 7 of these planned, designed to help you learn about strategy trading, developing trading ideas into strategies, backtesting those ideas, optimizing those ideas, and eventually automating your trading for hands-free trading. Really, everything you need to know about strategy trading. I'll be joined by my colleague, Tom Snyder, who's also has a lot of experience in this area. Tom, thanks for joining me.
Mike, it's my pleasure, and you're right. In my previous life, my previous careers, I've done a lot of back testing, a lot of strategy creation and analysis, all that good stuff. And to me, it's just a natural progression of looking at charts, looking at data, looking and seeing how the market works. And once you get an idea of, I noticed something about the market, you want to test that out, right? You want to see how would this have done had I acted a certain way when I see this set of requirements or conditions, whatever you want to call them. And, with the NinjaTrader platform, you can actually put those ideas into the chart and take out of the chart how you might have done, right? Systematic trading, taking that emotion out of trading gives you a little bit of sense of how you might have done as a trader.
Yeah, I couldn't agree more. So what we'll do, Tom, in this series is we'll talk about what makes up a strategy, right? We'll talk about how to build some robustness into a strategy. So that term to me is really important. You develop a strategy and you back test it. Maybe you do some optimization, but robustness is the concept of how well the strategy may do moving forward, right? When we look at a strategy, we back test it. We see how it's done, over some historical period of time. But what are the chances that that strategy will work the same way it was back tested moving forward? So being able to kind of look at different ways of determining robustness is really key, so that traders have confidence in the trading strategy that they're developing.
Right. And understanding what goes into that strategy can help you with some of the pitfalls or some of the nuances that you might not think about necessarily when you're placing a trade just on the chart trader or in an order ticket. But those actions, we have to think about that in terms of a strategy, how those are handled so that we can accurately represent how trading works looking backwards to get forward results. So it's not as easy as you think. It's actually quite, I think, a little more complicated than we know.
I agree, and that's what we'll try to do. We'll try to make those complications more simple, so someone has the confidence and to really try this and enhance their trading. So today we're gonna talk a little bit about the basic functionality of strategy trading in NinjaTrader, and then in the next episode we'll talk about what makes up a strategy, those components and elements of a trading strategy. We'll talk about, as we go through the series, we'll talk about performance reporting and evaluation, how to evaluate a strategy, what are the key performance metrics that you need to look at. We'll talk about one of the more advanced features in NinjaTrader, which is the strategy analyzer, which allows you to optimize the inputs around a trading strategy. We'll do automation best practices, and then you and I will get into kind of the nitty-gritty of developing different trading ideas, risk management, add risk management to our strategies, those kind of things. So I think there's going to be a lot of content here that you'll be able to really reach into. And if you want to start back testing, developing strategies in NinjaTrader, you'll have the tools that you need.
Yeah, I couldn't agree more. When I think of ideas and being able to test those ideas, when I came to this, it was print out the data, right? Export the data to an Excel spreadsheet, and maybe you were smart enough to, or the system was smart enough to mark in the spreadsheet where you had a condition fulfilled, and then you would have to go by hand to see, okay, I would have bought here. What was the price? Okay, when would I have gotten out? It might have been many lines later in the spreadsheet. And, okay, now I have to calculate the difference. Was it positive? Was it negative? Very, very kind of time intensive, right? And this is just, speeds so many things up that it's worth putting the effort into learning how to do it, because that investment in time to do that pays much, much more in dividends on the way, on the other side of that. So I think this will be a course that might be a little dense in information, but it certainly takes your trading understanding to the next level, and it's worth it, in my humble opinion.
Yeah, I totally agree with that. The research that goes into developing a strategy and back testing it gives you insights into the market. It gives you insights into price action that you couldn't get in any other way, because you get that performance feedback right away. So you suddenly see how a 5-minute strategy on a 5-minute chart can act very differently than a strategy on a daily chart. And so it gives you a lot of these kind of unique perspectives that you couldn't get on your own without being able to test different scenarios.
And to kind of go off on that, sometimes you might wonder why we hear about certain periods for a study. And I'm going to use the golden cross in the moving average, because we will be talking about that a little more. That idea of a moving average crossing another, and 50 and 200 are what you hear about on the TV news, or you might read about in an article. The question is why 50 and 200? Well, with the strategy an analyzer, with this idea of creating a strategy, you can not only see if that's a really good idea to use the 50 and 200, but the next question is there a better set of parameters? And like you said, Mike, a 5-minute strategy might produce very different results with those same parameters on a daily or a weekly or a 60-minute chart. So that's the benefit to me is, again, you can start testing what other people are saying about their studies, about their parameters, and say, you know what, I understand that somebody uses these parameters. Are they good for me? And from there, you can get a better understanding of not only the studies about the market, but about yourself.
I completely agree. You touched on it a little bit about, how this all started, right? Where, before computers, all of this was done very manually. And then, as computers evolved and more advanced software, these tools became, readily available for the everyday person. And that's not to say that it's easy. Developing a custom strategy requires, being able to describe the rules to the computer. And that requires a programming language. So, that is often a barrier for a lot of people who don't want to do this because they just don't want to learn programming. But there are a number of different ways that you can approach this without having to be a programmer.
Yeah, it's a little friendlier than, first glance, you might be, wow, taken aback. What do I have to learn? You know what? NinjaTrader does a great job of providing samples that can get you started, and I think keep you hooked enough that you have another idea, you'll be able to put that into your own strategy and analyze that.
And over the course of these segments, we will demonstrate how you can get your ideas into a strategy without necessarily having to do that programming yourself. So we'll provide some insights in that area as well. So we talked a little bit about the benefits here of strategy, trading and development. Maybe you can talk a little bit about just the overall process. How do you start? What are the different things that you do to get to that automated strategy?
Right. So with NinjaTrader, it's fairly simple. When you have a chart up, and we have an E-mini chart using the current front month, September. It's a daily chart. You could start with 5 minutes. You could start with a weekly, but we're starting with the daily. And it's as simple as right-clicking in the chart to get the menu. Now, you might be used to using this right-click to put on indicators or change your data series, right? But there's one that's right underneath indicators called strategies. So strategies are kind of, I don't know what you call enhanced studies, right? So you find the strategies section, and if you've never used this before, you'll see 4 sample strategies. Now, Mike has created his own, so he has some extra. But these 4 strategies that you see start with the moving average crossover. That is a basic interpretation of moving average, and I mean that in a primordial sense, not a simple sense, but it's a basic way to use the moving averages. And all you really need to do, well, first you need to hit add. Now, what happens when you hit add? You'll see inputs on the right side, and these inputs you can change. They are fixed right now because they are a sample, but you can change the elements of these the strategy. And Mike, if you want to talk a little bit about where you are right now.
So yeah, basically this is a moving average cross strategy. So when the fast moving average crosses over the slow, it's going to go long. And when the fast moving average crosses below the slow, it's going to go short. And you can adjust those two moving averages to whatever lengths that you want to test. And you can even optimize them to see which ones would be the most profitable. We'll do that in another episode. But right now, for example, I just want to look at a simple 3-bar moving average crossing over a 10-bar moving average. So super simple. I'm using smaller numbers here so we get a number of trades on the chart. And basically, it's going to trade whatever. And again, this goes back, Tom, maybe talk a little bit about the environment, right? So when we're back testing a strategy, this is done in a chart, and there's other elements, a symbol and interval.
Right, exactly. And remember, we're testing over data that has already happened. This is data sitting in a database. So we have to tell the software what kind of data are we pulling in. And we did that to some extent with the chart. We started with a daily, right? So it read from the chart that we were using a daily time frame. But also you have to tell it how far back to go. So it knows how much data to pull in. I'm trying to see on this. Do we have that, Mike, right here?
So let's put the strategy on the chart first.
Yeah, no, that's a great point. Let's put the strategy on, and it's going to blanket it onto the entire chart.
Correct. And then we can adjust the data that's in the chart once the strategy's there.
Exactly.
So here's the tricky thing, Tom, here in NinjaTrader.
Yes.
Most important thing, you might want to make a note of this so that you don't forget it. When you apply a strategy to the chart, the most important thing to do is click the enable button here. If you put the strategy on the chart and there's no trades, chances are you did not check this enabled button. So make sure you check that, click apply, and click OK. And in this case, the sample indicator, Tom also puts the indicator on there so we can actually test to see if the trades are happening when we expect them to happen when the moving averages cross.
Right. And that enable is kind of like locking in your choices, right? So any change you made in that template that Mike had up, if you hit enable, it locks it all down so it can throw it onto the chart. And then it locks it in because when we do other things with it, such as analyze the data, we want to make sure that our chart is looking at the same results as we would when we actually pull the data out and we have another view. So we'll get into that a little bit later. What's interesting here is it not only puts the studies on there, but it also turns on the text feature of the chart. So you might not have that text feature on. It should turn it on so that it puts the labels and the text labels where the trades were taken in the test itself. This isn't where you actually traded, most likely, but this is where the sample strategy would have taken trades and recorded as if they were live had you followed along live as the data happened.
So that's a cool feature here. So once you have the strategy on the chart, you have it, you're trading in the simulator for the most part at this point. You're just beginning. You can watch the strategy evolve over time in real time. This is a daily chart, so it only updates once a day, but on an intraday chart, this would be updating as each new bar occurs. So again, this strategy is a reversing strategy. We talked about that. It goes long and short. There's no other exit criteria. There's no other risk management. It's simply a simple test showing you where it goes long and where it goes short as those moving averages cross.
And Mike, that's a good point. Each trade, because really you're trying to replicate what would happen in real life. And so when you go long, you're also you're closing one position, let's say a short position, and then you're opening another by going long. So you actually have to go long twice. So that's why in every instance you see text here, you actually have two trades going on because it is a stop and reverse system. You're getting out of one trade, you're closing that position, and then you're going into another trade, whatever that direction the system will tell you. It'll either buy or sell, but it'll enact that trade at the same price as the close of the position. So it truly is a stop and reverse as it's set up right now.
Agreed. I'm just going to just take 1 minute here, Tom, to just adjust these two moving averages so they're a little bit thicker so that we can see them. It just takes a second here. And so here we can see more clearly the green line there is the slow moving average, and the goldenrod is the fast moving average. So that's the 3, this is the 10. And you'll notice that here, that goldenrod is crossing above the green. It's kind of in between these bars. So this is the trigger bar. Well, let's call it that. So this is the bar in which the cross occurs. When that bar closes, it generates a market order to be filled immediately. The first opportunity for that market order to be filled is the open of the next bar. And so there you can see a little blue tick mark at the open of that little red candle. That's where we bought, and that is where we also bought to close the short. So Tom was right. 2 orders go in and reverse the trade.
And I think, you know, you made a point, Mike, about the cross and the execution. You know, it's important to remember crosses generally happen between bars, right? The only time you'll see a cross happen on a bar really is when the moving average values are equal to each other on that bar. But if it doesn't happen on that bar, it'll happen between bars. So it might look like our entries and exits are kind of, you know, a little bit farther away from where we crossed, but really Mike's point about we execute after we confirm a cross. That big red candle or green candle that Mike pointed out, that's not confirmed until the end of the day, even though it was a big bullish candle and we know probably this will cross. Anything can happen. This candle could have turned around and we could have uncrossed. We could have not have crossed yet. So we have to wait for that confirmation candle to finish before we even think about taking our trade on the next candle.
So in this case, we are evaluating the strategy at the close of the bar, and we're looking at daily bars here on the ES. So the bar must close, and once it closes, it evaluates the strategy to see if any orders or any conditions are true that would then be processed and executed on the next bar. So
Yes.
this could be a minute chart. And it could be calculating intra-bar. There's even the ability to calculate intra-bar for day traders. So there's a lot of functionality here that we have to cover, Tom, over the next few segments.
I agree. You know, one thing too, Mike, there's an added feature to the chart that you enabled by putting the strategy on, and that is it's that line, right? The one that connects the bars that where you executed the trades to show the trend of the market from bar to bar.
Correct. So basically what you always see these lines. If it's a losing trade, it's going to be a red line. If it's a winning trade, it's going to be a green line. And right now it's going trade to trade because we're reversing. But let's say you have a profit target or stop loss, it's going to draw that line from your entry to that profit or target or stop loss line. So you can always see on the chart very clearly the duration of that trade on the bars exactly. All right, let's look at the performance of this chart, Tom. So all of the trades that we have in the chart here, if we just kind of scroll back, you can see all of these trades that occurred historically throughout the chart. I don't know why I'm having trouble scrolling.
And Mike, that's a good point. You could look at the performance trade by trade. If you're a visual person like me, it might be interesting to scroll back and just see, okay, was this trade? Is it a short trade? Is it a long trade? What was happening before? What was happening after? It might give you some ideas of how this system behaves in the trend that we're in, if it's consolidating, if it's a downtrend, an uptrend. You know, it's a good thing to do. But, you know, I think where Mike is going with this is if you wanted to find kind of a summary, right? I don't want to look at every trade and to find out if this was overall positive or overall negative to my P&L. we have tools for that.
Agreed. Agreed. Let's take a look at that performance report. So again, all of the trades here are compiled into a pretty comprehensive performance report. You right click on the chart, and right below strategies is strategy performance. You can have multiple strategies applied to the same chart. So that's why there's this little dialogue to the left here. We only have one. I'm going to click on that and click historical, and this will give us the performance of all of the trades in the chart. So there's that report, Tom. It shows you all trades, combining the long trades and the short trades, and it breaks out the short trades and the long trades from each other. Here you can see that the long trades here in the E-mini on a daily chart are well outperforming the short trades, and that's pretty easy to understand.
And it even breaks down the long trades in profitable and not profitable, right? Profits and losses, which is an interesting comparison. It's easy for us to understand what's going on here because we've been in an uptrend since October of 2023, maybe a little bit low, maybe October 2022. And so if we're looking back a year, that takes us past October of last year. So if you're in an uptrend, you would expect long trades to do better than short trades. It's that whole idea of trading with the trend versus contra trend trades. But it also, if you don't know that, if it's a new market to you, you want to test your strategy on a market that's unknown to you, or if you're looking at different time frames you're not as familiar with, this can give a good sense of, well, this strategy does well on both the long and the short side, or maybe it's just the short side. Well, now I want to see if we're in a downtrend. But the idea of how well it does with its winning trades and its losing trades in one direction is a pretty neat feature.
Yes, I completely agree. It's interesting, you know, we also have the ability here, and I love this grid view of the performance, but a picture is worth 1,000 words, Tom, and I always look at the equity curve.
Yes.
So the equity curve really kind of tells you how this strategy is performed over time. Every strategy is going to have some drawdowns, but is it consistently making profits over time? That's really kind of what we're looking for. And that's what we're seeing here for the most part. And again, I want to point out, and I think you'll agree with this, Tom, that a strategy doesn't have to be long and short. You don't have to have a strategy. If you're in a particular environment, a particular market where you only want to go long, that's a valid strategy. If you only want to go short, that's a valid strategy. So it really, you can tailor, you know, your idea to the market that you want to trade.
Yeah, I agree. You can go long only. You can, this is, doesn't include protective stops, right? So if you want to limit your losses, you know, we'll get into it in another segment, how you can add those protective features, or maybe there are different ways to get out. We're using moving averages to get in and out, but you might get in a trade with one setup and you might get out a myriad of ways, right? Multiple ways. So this is very basic. And for a very basic strategy, Mike, I'm kind of impressed that it looks the way the equity curve looks the way it does.
Well, this is a factor of what you just said. We've been in an uptrend. So if you were to pick just random places to go long over the last year and a half, you'd probably have an equity curve very similar to this, right?
Yes.
But to your point earlier, this isn't the way that people trade. They don't trade long, short, long, short. They find a setup and a filter and a trigger, and they go long, and then they manage that trade with maybe a trailing stop or a profit target or a stop loss. And those are the kind of elements that we will talk about in our next episode, is what makes up a trading strategies. You know, so we'll look at things like the different components of a strategy, entries and exits, trade size rules. We'll talk about different ways that you can kind of build those rules and best practices on developing a strategy.
Right. And that's just the beginning. I mean, that's there's so much more planned with optimization. And then, The way I see this evolving, Mike, is we might even get into the point where we can help code your strategies, right? Send us an idea and we'll use it as an example, but that's a little bit down the road. We want to make sure that all the basics are taken care of so that you can start doing this on your own if you choose to. If you don't want to wait for every Friday, you can do this on your own.
Before we go, I want to show one other advanced feature that we'll be talking about later in the course, and that is the I'm going to go to the control center. Let me bring that into view. There we go. And if you go to new and strategy analyzer, this is another way that you can backtest your strategy outside of a chart. Instead of having a chart, you can select the strategy that you want to backtest. You have all the inputs. You can choose to optimize your strategy here. And it's just a much more efficient, much faster way of backtesting different ideas very quickly. And it has the strategy performance report built right in.
Yeah, it is a great interface. One thing also, we have the summary here. You can break this down to see the individual trades, just like you would with your own, funded account, right? You want to see how your trades were for this month. Well, you can do that with a strategy with this strategy as well. You don't necessarily have to. You're not limited to the summary. You could say, let me show each trade. And, you could download that or you could export it into Excel and do further analysis if you want. But just like our trading account, whether we're trading sim or with real money, has all these features of how to look at my trading activity. So does the strategy analysis. It's just paper trading essentially, but it's very sophisticated paper trading.
I couldn't have said it better. Tom, we are out of time. This has been fun. It went by too fast, but we'll be back next Friday talking about how to build strategies and the components of strategies. Thanks a lot, Tom.
Yeah, it was my pleasure. And yeah, it went too fast and I can't wait. I mean, this is really, to me, the fun part of trading and exploring what is out there. And, I can't wait.
Welcome, everyone. I'm Michael Burke with NinjaTrader, joined by Tom Snyder. This is our second session of our Foundational Strategy Trading and Development course. Tom, thanks for joining me.
Mike, it's my pleasure. I really enjoying these segments and can't wait to do what we're doing today.
This is such a key component of the NinjaTrader platform and such an important step in the development of being a trader is the ability to look at a trading idea, be able to measure the performance, kind of see its strengths and weaknesses, and strategy trading helps you do all that.
Yeah, I mean, I always thought that strategy trading was the next natural evolution of looking at a chart, looking at studies, and it kind of helps you answer the question of what if. And NinjaTrader does it in such a simple style, but there's a lot of moving parts, so we still have to go over quite a bit.
I agree. Let's kind of level set and talk a little bit about what a strategy trading is. So, in my mind, a trading strategy is a historically tested set of rules for entering and exiting the market. The key word there, historically tested. Right? The idea of a strategy is to look at an idea historically and then determine whether that is something that you want to trade moving forward. And in Ninja, strategies are written in a programming language called NinjaScript. And it's a very powerful language that allows you to describe virtually any idea to the computer and test it historically. But the ultimate goal here is to turn that trading strategy into an automated strategy for hands-free program trading. So it frees up your time, it instills more discipline, and it helps, eliminate emotions.
Oh, I agree. And, part of that automation is trying to find what might be a better set of parameters, a better strategy, right? I can have an idea that I hear about on TV and think this is the bee's knees, but if I test it in NinjaTrader, there might be a better set of parameters, of exits, of all these different factors that go into a strategy. And that's the goal, is we want to become better traders. Let's try to make that, fine tune that tool that accomplishes what we're trying to do in the best way.
I agree. So Tom, I think the best way to approach today we're going to be talking about the different components and elements that make up a trading strategy. And so I think the best approach here is for us to look at a sample chart, and we'll use one of the sample strategies that come with NinjaTrader. Oh, before we start here, I just want to point out that I put the link into the chat to our first session. So if you missed that first session, the link is in the chat, and you can watch that after this session if you'd like. And these will all be online. So this is a series you may want to watch a couple of times. So we'll have all of these videos for you, either on YouTube or in our Learn Page dashboard. Okay, so Tom, I'm just going to kind of talk through what we have here in the chart.
Sure.
We have the sample moving average strategy that comes with NinjaTrader. You can access that strategy by right-clicking and going to strategies. And it's right there. I have some other strategies that I'm working on here, but this is the sample strategy that comes with NinjaTrader. You add it in here, and I've changed the parameters. And I'm going to talk a little bit about this enabled button because it's a kind of a gotcha if you don't know about it. So I've changed our strategy to a 310. This is going to be on a daily chart. We're looking for a 3-bar average to cross above or below a 10-bar moving average, and the strategy will reverse. It'll go long and short. So you can adjust those inputs here. You can optimize those inputs in the strategy analyzer, which we'll talk about in a couple of sessions from now. But the trick is, once you've added it in here, you've put in those parameters, there's a checkbox here that's really important. It's clicked enabled. So if you don't click that, the strategy will not apply to the chart. So once you click that, you click apply, and you've got the strategy in the chart. Now, if you go through that process and there's no buys or sells, chances are the problem is that you didn't click or press apply to that enable button. So that's kind of the gotcha you got to know. So Tom, maybe talk a little bit about the chart as a laboratory for our backtesting. This is kind of a scientific process, right?
Right.
You have an idea, you have different conditions. So the chart kind of makes the laboratory.
Right. The chart is the visual display of what we are trying to replicate in when we trade, right? So what is that chart? Well, the chart is, first off, the data. And how do we define the data? We define it really in two ways. We define it by a symbol. What market are we looking at? And also the time period, actually 3 ways. A range as well. Range is important when we're talking about back testing, because the more data we test, the more instances which of buys and sells, and just from an analysis standpoint, the better it is to have more data for the most part. And then you have, so that's kind of the background in which the data is defined. Right now, Mike has a chart up of the E-mini S&P September contract, and it is a daily chart. And I'm assuming there's probably at least a year's worth of data. Right now, we don't need to know that because we're exploring ideas, and that's the laboratory part of it that Mike mentioned. The idea of what would happen if we took a trade when the 3-period moving average crosses above or below the 10-period. And so rather than just putting those moving averages on, it actually marks the chart where those trades would be. And it's not just taking a trade to go long, to go long when that happens, But it's also a trade to get out of a short position, right? So you'll notice every time we have an action, there's a close position and a sell short or buy long position. So that's kind of what that in laboratory is. It allows us to see what would happen if we traded those two moving averages in real time.
To your point, I'm going to right click on the chart, go to data series. And this is where you set how many days is in the chart for your back test. So you might want to test on 1 year of data or 2 years of data. And this is where you can do that. The other thing with this is that you don't have to test from today going back a year. You could test any time in history and look at a particular time. So maybe you want to trade, during COVID. You want to see what that chart looked like during the COVID period. You could move that data to that time frame. So there's a lot of flexibility here. And I agree with you. How much time, how much data you add to the strategy, we'll talk about that a little bit on why you would add more or why you would add less data, depending on what you're back testing. So there's some best practices around that we can talk about as well.
The other thing regarding data, since we're on the topic, futures are unique because they are time-sensitive instruments. They have an ending, right? They expire. So when we create charts going back multiple years, we're using different contracts. We're generally using the front month, and we're stitching together these different contracts to form a chart. And that leaves us with a problem or a question, and that is, how do we handle the data at the roll? Now, Mike, as we've seen on the live streams, he likes to look at unadjusted data. Where did the price actually trade? And that's great for reporting, and there are very good reasons to do that. But there's another way to do that, and that's to adjust the data. The way I refer to it is you move the data up or down at the roll to kind of match a seamless chart. And that's like looking at the previous contracts in terms of today's pricing. Why is that important? Well, in technical analysis, when we have moving averages, it leads to a smoother moving average. So the trade-off is you don't get the actual prices. For backtesting purposes, you would want to choose or know which kind of data you're using, because that will affect your studies, whether it's adjusted or unadjusted. And it will also possibly affect your exits. If you have an absolute value trail stop, right? I want to trail 10 ticks. That's fine. You can use that on either adjusted or unadjusted. But once you get into percentage-based stops, targets, modifications, then you probably want to use the unadjusted. That's my little speech. We can talk about it offline, but just know what kind of data, and you could test using unadjusted and do another test with adjusted and see what results work best for you.
Yeah, I think I completely agree with that. That's a good approach. For back testing, I typically use adjusted data, simply because this is a statistical kind of, like I said, scientific endeavor. So I want to see the kind of the smoothed version of the strategy for my back testing, for the moving averages, and for the other indicators that I'm using.
I agree too. I'll add to that. When we talk about unadjusted data, there is a gap. When you roll in, roll out, your trades are going to adjust for that gap anyway. So it's good to adjust the data for back testing.
And and I guess what makes the reason we're saying this is because that, again, we're not looking for the back test to be an exact representation of how it might have traded historically, and we don't expect that it's going to trade exactly the way it back tests when we trade it forward. What we're really looking for here is a body of information that gives us confidence that we can trade it forward. Nothing is exact here, but we want the best representation of that historical performance.
And to that point, Mike, that brings us to kind of probabilities and percentages and things that we'll cover in the next segment, which is how do you analyze the statistics that come out of a strategy, which helps with what Mike is saying. Do I feel comfortable with this, well, you could look at a picture, but it's probably better to look at the measures or the statistics that come out of it. And we'll go through those in another episode.
Yeah, that's one of the fun parts of strategy trading is creating a scenario and looking at the back test and then adjusting that scenario a little bit and looking at the back test and see whether it got better or worse. Strategy trading is a very incremental process where you're constantly refining. And so looking at those performance reports and those equity curves is really the fun part of this.
It's like tightening a chain or loosening a chain on a bicycle, Mike.
And we'll talk about all the different things that Tom and I look at when we're evaluating the strategy, what those performance measures mean and which ones to focus in on. So Tom, we're talking today about the components that make up a strategy, right? So basically there's an entry component that can be made up of several different kinds of entries. And let's focus on that first. We've got a chart up, and you and I talked about some of the things that we look at in a trend-based strategy. Might be the ADX indicator or the volume indicator. Maybe touch a little bit on what are all those components that can make up an entry strategy.
Right. So the entry would be that signal. Some people call it a signal that would get you into a long or a short trade. And in the case of the example, we've talked about the moving averages crossing, but what Mike is also mentioning is we're not limited to just the cross of the 3 and the 10 or the 10 and the 25 in the sample or whatever it is. You can also add, I would say, status or other conditions that would amplify or hopefully get those statistics that we mentioned kind of on the right side of where you want to be. Meaning, if I can add an entry that says, okay, I want to go long with when the 3 crosses above the 10 moving average, but I only want to take that when the trend is increasing or when there is a trend, right? I don't want to take it in a flat environment. I want to take it when the trend is increasing. So Mike has an ADX right there, right underneath the chart. And that's, if you saw our book club yesterday, Wells Wilder developed ADX. It's a trend strength, not a direction study. And it's just above a certain threshold. I like 25. Some people use 20, some people use 30, but above a certain level, it's saying, hey, this market is trending. I don't know what direction, but it's trending. So you could put in a qualifier to your entry that says, okay, I want to trade when we cross the 3 crosses the 10, but also when the ADX is above 25. That's as simple as I think I can make it with the ADX. Because the other side of that is, well, ADX, if it isn't above 25, it's probably below 25. And I don't want to trade when there's no trend.
So I like that. So the way I think of it is that we have our, like you said, we have our entry condition. I think of that as a trigger. So when the fast crosses below the slow, that's what generates the order. That's what triggers the order, right? And what you're talking about with ADX, that's kind of the setup of the strategy, right? We wait for ADX to go above 25, and then once that condition is true, we wait for that trigger. And if it's not above 25, then the trigger doesn't, if the trigger happens, we don't take the trade. So those are the kinds of conditional rules that you can build into a strategy, and the possibilities of combinations is really unlimited. It's a really a broad palette of tools that you can use.
Right. And Mike has on the bottom panel, he has volume. Like, okay, volume, that's kind of a standard thing for a daily chart. I look at those, you look at those. We look, anywhere we go, we see a chart usually has volume. But what you can do is you can add a moving average of volume. Aha. Now, question is, do I want to trade on a light volume day, or do I want to trade when there's a lot of volume? And when I say trade, we're talking about analyzing a trade. So we're looking back, we're paper trading, where you can look at this as analytics, but that's what we're trying to represent is how would we have trade. I generally would like to trade when there's more volume. It's hard to trade when there's light volume. So what can we put on that that volume is a moving average of volume. So there might be another condition like the one with ADX. I only want to take a trade when we're trending. I also want to take a trade when volume is above the average. And so, it's up to you to determine what average is good for you. It could be a 10 period, it could be a 20 period, whatever it is. That is also something you can back test, right? You can see what's best for me, but you could say, I want to use this condition regarding volume, this condition regarding trend, and then my trigger is going to be the momentum or the averages crossing. And so when Mike says there's endless possibilities, it really is true. Thinking how many studies there are and how many combinations you can use.
And the thing is that, once you have a little bit of skill in NinjaScript, you can just swap these ideas in and out very easily. So if ADX isn't working, you can swap in the volume. If the volume isn't working, maybe you can swap in some other indicator, and until you refine it. Sometimes the core trigger is all you need. So it can be a combination of a lot of different things. But like you said, the possibilities here are really endless.
And that's the great thing is these results can be exported. So you can make that comparison, right? If I want to see how this would have done with that ADX filter, I call them filters, or the volume filter, I want to compare it to just the signals. You can just export it and see, did it make a difference at all? Or did it make too much of a difference? Did it cut out all my trades? Well, then back to the drawing board and let's see if there's something else that can enhance this strategy.
I agree completely. So Tom, basically the strategy we have here is a reversing strategy, which is typically not a very robust strategy to trade. There's usually additional exit criteria. It could be a technical exit. It could be money management. Maybe touch on, how you have an entry condition or set of conditions, but then there's typically another set of conditions for getting out.
Right. So I look at it, you could have one way to get in a trade, but you should have multiple ways to get out of a trade, right? When we trade real time, when we're trading day trading and we're just using our chart trader, there's nothing automated. We always talk about having a stop and a target. You should know what you're trying to achieve. And this really is no different. So you would want to definitely have an exit that defines your stop loss. And that stop loss could be a number of ticks. It could be an ATR stop, right? A multiple of ATR. It could be a number of different things. But you want to have a stop in there. You also want to define a profitable exit, right? You don't want to have an exit that's going to, give you a negative P&L. You want to have something that can be profitable. So that could be, again, a set number of ticks. It could be a technical analysis stop that's different from the one you got in. It could be something where you got in with the moving averages, but you got out using Bollinger Bands or Keltner Channel or any number of different ways. It could be basically you name it, right? How do you look at the chart? You see a turnaround, there's a the 3-bar pattern, define that pattern and use that. So different ways to get out of a trade, profit and stop loss. Those are the two basic. So every trade or every entry, I think, should have at least those two. Then there's a special kind of stop. We've talked about this, a trailing stop. Some people call it a chandelier stop. Going back to Wells Wilder again, he has a study called the SAR, the stop and reverse, the parabolic study. That can be used as a trailing stop. So you could use that. But having some sort of stop that adjusts when you're profitable, so you don't give back your profits, that's another way to get out of a trade. One more that doesn't get a lot of love, but it's certainly something you can look at, is with a daily chart, you can say, I want to be in this trade for 5 bars and then get me out. I don't really care what's happening technically. And the purpose of that is, you might think that in a market, you see patterns where the average move for this market is 5 bars. Well, now you can use back testing to see if that's really true, or maybe it's 4 bars, or maybe it's 7 bars. You can actually test that and see what's most profitable for that kind of exit. Um, in an intraday chart, we might use timed or time considerations in terms of getting out before the session close. So I might not get my technical signal. I might not get my stop. I might not get my profit target, but I don't want to hold my position overnight. Let's say a minute or 5 minutes, whatever it is, before the close, I want to get out of this position. You can do that as well. So you think there's a lot of ways to get into a trade. There's a lot more ways to get out of a trade.
So, as you're describing that, one of the things that I think about is that, when you're back testing a symbol, and let's say you're going back 1 year or 2 years, the price of that instrument can change dramatically over that 1 or 2 years. NASDAQ may have moved 400 or 500 points, or crude oil could have moved up 5 or 6 points a barrel over that time frame, and now it's trading at a different price range than it was historically. So one of the things you have to think about is that when we're building these exits in that Tom is talking about, they really shouldn't be fixed amounts. It shouldn't be like 5 points or 10 points, because 10 points today may mean one thing, and 10 points, a year ago could mean something very different.
That's a very good point. Know your range in terms of time and price, right? If I'm testing on a 1 minute chart, I could be I'd be less concerned about that. But you're right, definitely over long periods of time. We just made new highs in the Dow Jones. What was the Dow Jones trading 5 years ago? 36,000. What was it 5 years before? 30,000. 1% of 30,000 might be a better or versus 40,000. That might be more representative of how you trade rather than 100-point stop or 100-point target. It's a much different, volatility being what it is. So totally agree with that, Mike.
So what we're saying is that instead of using those kind of fixed numbers or dollars for profit and target, it should be something more dynamic, like a percentage of the price, or a portion of the volatility using average true range. So just you want those exit numbers to be dynamic, so they mean the same thing as you back test. I think that's the thing we wanted to talk about. Exactly. The other thing that we haven't touched on yet, Tom, as an element or a component of a strategy, is the ability to scale in or out of a strategy as well. If you watch what Tom and Jim do, on the setup segment of NinjaTrader Live, very often they'll take one or two or I'll start over. They'll take 2 or 3 contracts and they'll scale. They'll either scale in or they'll scale out, and you can do that same thing in a strategy.
Yeah, and I think that's the basis of the turtle traders, right? Is buying on strength, selling on weakness, and it's as the trend continues, they might layer into a bigger position. And something I think you mentioned this week, Mike, it's okay to take a trade. You're already in a trade. Take a trade in the same direction if you feel that, hey, this is a good trend. That's good. That's good position management, I think. And you can do that all in the strategy analyzer.
I agree. The last thing I think we should touch on just briefly, Tom, is something you and I talked about, and that is going back to the laboratory or the chart environment as a laboratory. Different intervals or different ways of trading, are contingent on the interval in the chart. So you may know how you want to trade, and so you'll set up your chart in a certain way to develop certain kinds of strategies, whether they're intraday strategies or swing trading strategies or longer trading strategies. And so maybe touch a little bit on what traders should think about.
Right. So, when you're trading, let's go small to big. When we're talking about day trading, you're looking at smaller time intervals. You're talking about minutes, maybe tick charts, maybe 10-minute, 30-minute charts. And your studies, and what I've found is the studies that we use out of the box generally are set for daily time periods, and some can be use the same parameters for intraday. But I find what works best is when we're day trading and we're looking for those moves intraday, and we use these studies, we want to use shorter time frames. So maybe on an RSI, it could be a 9 period, or it could even be a 3 period RSI, versus a daily, which might be a 14 or even 21. The longer we get, swing traders are kind of that, I don't know, mid range, right? So they're holding positions overnight. You could look at a 60-minute chart, or you could look at a daily chart, probably use similar time frames. I think that all comes out in the wash when you optimize or when you backtest. And then longer term daily charts and up, you're going to use most likely kind of the standard settings or even maybe longer.
Yeah, I think that makes sense. You have to know the type of trader that you want to be a little bit here. And sometimes that's an evolution for a trader. So a lot of traders may think, they're looking at daily charts like we're looking at here, and I'm going to hold a trade for a few days. Eventually that person may evolve into a day trader looking at different indicators and different bar intervals. There's a lot here that helps a trader kind of understand themselves and understand the markets.
Yeah, and that's key when you start to optimize your systems. Know what the variables are in all aspects, right? You mentioned bar intervals. I don't think people pay enough attention when they optimize to saying, well, what if we did this on a 5-minute chart or a 10-minute chart or a 1-minute chart? You might get better results on a different time period than what you're looking at now, and that might be eye-opening too.
I agree. So Tom, we're out of time here. This is session 2 is under our belts. Next week we'll be looking at the strategy performance report. That'll be a fun segment.
Yeah, I can't wait. This is right in my wheelhouse. I know it's yours, so can't wait for next Friday.
Thanks everybody for being with us. I hope you're enjoying this series. As I said, I put the link to the first episode in the chat, so definitely take a look at that. But the idea here is we're going to keep going with this all the way through optimization and actual strategy development, putting some strategies together for you. So thanks so much for being with us. If you have any feedback or questions, be sure to send us an email at learn@ninjatrader.com. Tom, thanks for being with me.
Mike, my pleasure.
Welcome, everybody, to another edition of our Foundational Strategy Trading and Backtesting series. Today, we'll be talking about the Strategy Performance Report and how we can see how our strategy performed historically and what metrics we need to look at to see if there's a chance that the strategy will perform well trading forward. I'm joined today like I always am, by Tom Snyder, CMT. Tom, thanks for being with us.
Mike, it's my pleasure. How you doing today?
Good. So this is a topic that I think is key for strategy trading. Let's just level set a little bit here. The idea here is that strategy trading is really a positive step for a trader, someone who wants to become a trader. Strategy trading allows you to kind of do to get a deeper understanding of market behavior, price movement, and how different indicators react with the market, right? So, I think you agree with me. What else do you think here is key about strategy trading?
Well, I think it's just the concept of taking an idea that you might observe in the market and applying it to historical data so you can see how that idea might have performed if you had put trading rules around it. So that idea might be as simple as a price crossing a level or price crossing an indicator, or it could be more complex where you introduce several indicators or other conditions to kind of represent your idea of what's happening in the market and where you might find favorable trade conditions. How would that have performed? And instead of doing that visually, right, looking at it trade by trade. There's certainly room for error when we do that. This actually is automated in the sense that, well, just look at the data and apply these rules to the data. So it is really not only just a key thing to evaluate trade ideas, but it's also an efficiency tool as well.
So I kind of think of it as an essential feedback loop, right? That allows you to look at many of the different metrics and elements that make up the performance of your trading strategy, and that's what we're going to be talking about today. Is that strategy trading report here in the NinjaTrader platform. So to get started, Tom, I'm going to start with a chart. In order to bring up the performance report, we have to apply a strategy to the chart. Now, I already have one on the chart, so let's take a look at that chart. And I'm going to show you what we have here is a simple moving average cross strategy. This is a sample that comes with NinjaTrader. And I've set the inputs to a 3-bar moving average, which is the gold line there, crossing a 10-bar moving average, which is the green line there. And on the chart, the strategy goes back, and everywhere there's a cross, it creates a strategy entry and exit for each of those trades. It's reversing, going long, short, long, short. And it compiles all of those trades into our performance report. So just to level set here, I'm going to right click on the strategy on the chart and show you how you add a strategy into the chart. So on the strategies dialog, there are some sample strategies here. I'm working on some of my own strategies as well. But you select the strategy that you want to add to the chart, click add, and bring it into the chart here. Now, there's something really important here I want to point out, and that is that there is an enable button here on the right. A lot of times people will try to work with strategies and nothing ever shows up on the chart. And the reason that is because they haven't enabled the strategy within the chart. So that checkbox is really important. And then once you do that, you've got the strategy on the chart. In this case, this strategy also inserts the moving averages, which is super convenient. A lot of times if you have custom indicators, you have to put those on the chart, and then you put on the strategy and make sure that the rules line up correctly. But in this case, it's done for us automatically, which is really nice.
And that gives you the ability to check that the conditions for trading are represented correctly, right? So you can see the studies and where you would expect trades to happen. They actually happen. I want to say one thing about that enabled button, because it has perplexed some people, including myself, I know. It's there kind of like to lock in the variables of your strategy. So think of it as we're in 2 modes. One is an experimental mode where we can tweak the dials and levers, but once we've got those dials and levers tweaked the way we want, we lock it in, and then we see the display. That's the enable button.
Yeah, that's a super good point. To your point earlier in evaluating the price action to the indicator and seeing those buy and sells on the chart, every indicator and every strategy in NinjaTrader is written in NinjaScript. And so the rules for your strategy are in that NinjaScript. And so you may have an idea for a rule, but did those ideas get properly translated into NinjaScript? And is it generating the trades exactly the way you think they will? So that's a key point. I'm going to right click and go to strategy performance. This is where we can bring up that strategy performance report. We're looking at the sample moving average crossover, and we're going to look at this historically. So Tom, talk a little bit about the chart environment. We're looking at a daily chart of ES. That's really kind of the environment that we're backtesting in, the laboratory, so to speak.
Exactly. And that's something you need to define. I mean, it's defined for you when you apply the strategy, kind of takes a default view. But there's 3 things we need. We need a market that we're trading. That's the symbol. That's the ES September 24 that Mike has up there. You need a periodicity, in this case daily, and then a date range. So you kind of set the start and end of the data that you're looking at to evaluate your trades. In this case, I think we go back to the beginning of this year, but you could certainly test different date ranges, which is, I think, a really key part of, getting into the weeds with strategy testing, because, the whole idea is we just don't want to test a little slice of the pie and then assume that this is the best strategy ever and let's go forward. You want to do different slices of the time history that you have and test that. But those are the three things we need for the laboratory environment. We need a symbol, we need a periodicity, and we need a range of that data. And you can see here, right in the second, let's call it section, start date and end date. That's where I know that this started at the beginning of the year.
Yeah, that's a really good point. Let me do a little bit of geography here on the performance report, and then we'll talk about some of the actual metrics here. So when you bring up the performance report, you get the initial summary page, which gives you all trades, long trades, and short trades in 3 nice columns. You can see all the different performance metrics here on the left. And then if I click on the drop down here in the upper right, if I select analysis, this gives me the equity curve for the strategy. It also shows the different periods of the strategy with some metrics there as well. You can see the different executions. This is the trade by trade list for all the trades with that occurred historically in the chart. And I'm sorry, executions is the orders that were placed during the back test. Trades actually shows you each of the trades that were made. There were 16 trades in this back test, and basically that's the idea here. So let's go back to the summary page here, and Tom, let's talk about some of the key performance metrics that strategy traders need to kind of zoom in on.
Right. And I think it starts off great with this list, right? Total net profit. I mean, this is the bottom line, literally. This is your balance sheet. This is, are we profitable or not in this simulated mode, according to the history, had we traded this way? Of course, with back testing, it can't ever be, we can't go back in time and test it, but this is representative of the data that we have, the historical data. And so that total net profit reflects, is this strategy at least profitable or not? Is it something that we should continue pursuing? And then breaking it down into long trades and short trades on the right helps us determine which, if there's anything we need to know about the long trades or the short trades. Is there a difference? Right now, I can see that even though we're profitable overall, the long trades very much outweigh the short trades. Long trades are profitable, short trades are not profitable. And then you just kind of delve a little bit deeper into, well, is it an equal match? Is it the long trades are more profitable than the short trades? In this case, they are. And by how much? And is that acceptable? Now, you could stop there and you could say, well, that's a great way to evaluate, but there's so much more to this that you're missing out. And, total net profit is, to me, is like, I look at it and see if it's red or black. And that's really not my total concern. What I'm more concerned about is some of the deeper analysis. Percent profitable, I think, is one that we should take a look at. And, that's something where if you go down to the third section, you get the total number of trades. There were 16 trades. 50% of them were profitable. So that's like a coin flip. How are we so profitable when we had half the trades losing? Well, that's kind of like trading, right? You don't have to be profitable on every trade. You can be profitable on half the trades as long as those that are profitable outweigh the ones that are not profitable. That's fine. So it gives me a sense of how successful will I be if I traded just like this. 1 out of every 2 I'm going to win, 1 out of every 2 I'm going to lose. I have to manage my expectations if we said, this is my system and I want to use that going forward.
Yeah, that makes perfect sense. In my mind, I agree that net profit number kind of just says, is this worth looking at right now? Or should I try something else? Should I try another symbol, another interval? But even if you have a good trade net profit, there are so many other elements that go into the tradability, in my mind, for a strategy, including, as you brought up, that percent profitable. I think that's a key one. For me, one of the key metrics here is, if you come down just a little bit more, is that average trade. So what average trade means is that whether you have a winning trade or a losing trade, every time you put on a trade, you're putting $1,200 in this case into your pocket. Some trades will be winners, some will be losers, but over the 16 trades, I put $1,200 in my pocket on average. So that's an interesting number. And if when we look at whether a strategy is worth trading or not, the question is that average trade worth the amount of risk that I'm putting into that trade? So what is the margin for this symbol? And how much money do I have at risk? And for how long do I have that trade on? Oh, how many days is a daily chart? So it's a swing trading strategy. So I'm risking X number of dollars to make $1,200 per trade. There's a lot that goes into that calculus.
Oh, I completely agree. That average trade, when you talk about risk, sometimes it's not about what you want to risk, but how volatile the market is. So you might be trading at a time where there's higher volatility versus lower volatility, and you have to adjust your risk parameters accordingly. And it might not be worth to take the trade if your risk is too much. If you're only going to make, let's say, only $1,200 on this trade in this example, well, if the market could go against you twice that much, is it worth it? That might be something to think about.
And we'll talk about that risk a little bit as we go a little bit further into this session when we talk about equity curve analysis and that kind of thing. I want to go back and touch a little bit on this concept of tradability, because there's one of the other performance measures that I think is really important to me is this row that's called maximum consecutive losers. So that's an interesting number. And in this case, it's only two. And this strategy over 16 trades only had 2 losing trades in a row. But very often, you'll have a really strategy that looks really good, but it'll have 4 or 5 losing trades in a row. And you have to ask yourself, am I able, emotionally to trade through 4 or 5 consecutive losing trades and then put on that next trade? Do I have enough confidence to put on that next trade? So I think the answer for most people is no. If I've lost 4 trades in a row, I am not putting on that 5th trade. I don't care what the strategy performance report is telling me. So that strategy, in my mind, is not tradable. So even though it's a great strategy, has a great performance report, unless you're willing to actually let the strategy play out, you don't have a strategy yet.
Completely agree, Mike. That is a great point, because that addresses the emotional point of trading, not necessarily your P&L or your account balance or anything. It is emotional. And one thing to think about too is we're only looking to the beginning of the year, and we know that this year has been a bullish year. We also want to test further back, maybe incorporate more data back to 2023 or 2022, which was bearish. And those statistics will change. Of course, the P&L will change because we have more data, but also the consecutive winners, consecutive losers might change. So this goes back to that idea of testing on different data sets, meaning time periods, or in making that time period to that time range bigger to see if that is consistent. If I go back 20 years and I see the maximum consecutive losers is still 2, well, I'd be very surprised. But if that's the case, then I feel better about the robustness of the strategy.
Yeah, it's an interesting point, because a lot of times when you're looking at the strategy in these kinds of things, in this case, long trades and short trades, right? If you look at this strategy, the long trades have done well this year. Well, of course they have, right? Because we're in a long-term uptrend all year. You would expect the long trades to do well and the short trades not to do well. And this goes back to another philosophy that I have, is that you don't have to trade long and short. You can just trade a strategy long or just trade a strategy short, depending on that market environment. If you're in a strong trending market, bonds tend to trend well. If it's in that, in a downtrend, why would you try to buck the system and go long? And of course, the timing of when you're trading a strategy long or short, or you're trading it just long or just short, that is on the trader to make that decision. But I just want to be clear that I don't believe that you have to always trade long short. You can trade, the market that you're looking at.
Right. So many times we hear traders say, I love a short market, or I love to be long. And you could you could have your strategy reflect that. I look at a stop and reverse system, Mike, especially talking about technicals, as a way to evaluate the technical study that I'm looking at, that I'm using, not necessarily to look at the trade that I want. If I find that this does better in long trades, regardless of the overall trend, then I might incorporate just this indicator when I'm trying to get out of a short or into a long position. And so that might go into another strategy I test. So, we can be pretty flexible with our intentions with these long, short data that we get with these analyses.
Yeah, I agree. One of the things that traders look at very often is things like profit factor. You talked a little bit earlier about the percent profitable. One of the things that we've learned over the years is that different types of strategies have different kinds of performance profiles. So in my mind, for example, Tom, and I'd love to hear your opinion on this, trending strategies typically are right 45% of the time, and counter trending strategies are typically right about 55% of the time. And of course, there's a wide variance in there. But the idea is that if I come to this performance report and I'm looking at a trending strategy, 50% is pretty good, because normally it would be 55. If this was a counter trending strategy, I would think that percent profitable is a bit underwhelming, right?
Right.
And same thing with profit factor. A counter trending strategy has a profit factor usually closer to 1 to 1, whereas a trending strategy might have a profit factor of 1.5 or 2 to 1. So the performance report is dynamic to the type of strategy that you're trading.
Exactly, exactly. And this is one way to compare strategies, whether it's different strategies using different signals or the same strategy over different time periods, to give you a sense of was this, did I tweak this a little bit and make it more profitable? Profit factor goes up. Okay, great. I like that. Or maybe it's comparing different time frames. Wow, this did really well in a consolidating market, but it didn't do so well in a bullish or a bearish market. I'm going to keep that in, back of my mind, to think, maybe I only use a strategy in consolidating markets. So that's can be used as a way to compare different strategies as well.
And I think we could also add to that the time frame. Intraday strategies may react differently than swing trading strategies. And again, there may be a different set of performance measures that are more critical to that evaluation.
Right, right.
So, I say this all the time, a picture is worth $1,000. I'm going to go to the drop down up here and look at the analysis dialog. And this is really the equity curve. Can you talk a little bit about what we're looking at here?
So what you're looking at is on the top, you're looking at every trade that was made and the data that goes along with it, which is basically balance sheet type of information. Was this trade profitable? Was there commission? We don't have commission factored into this, but it also adjusts the stats for the averages and all that. But I think what's really cool is the picture that Mike mentioned on the bottom is that equity curve, that every time we trade, we reevaluate what the P&L of that trade was, and we basically add it or subtract it, right, if it's positive or negative. So over time, you can see, was this strategy profitable? And looking back at the beginning of the year, this first trade might have happened, it looks like sometime in February. You can see the progression of the equity curve as this becomes profitable. It took a little time to get profitable. It was in March that it got profitable. It went from negative and having the red cloud to green and positive. And you can see where those pullbacks were. If you're profitable, you can see where it turned up. If you're negative, you can see where it turned up and started to be positive. But this represents the P&L over time for your trading system.
The thing we're looking for here is to see that equity curve building new equity peaks as we go through time. And so you can see here the little green dot, that's an equity peak up until that point in the strategy. And then this one is a little bit higher. This one's a little bit higher. Of course, this one is much, much higher. And that's what we're looking for. We're looking for consistent equity, higher equity peaks throughout the historical backtest. The other thing I want to just kind of touch on is we hear the term drawdown all the time, right? What is the drawdown for a strategy? And the maximum drawdown for a strategy is a measure of risk. And the way we measure that risk is by looking at these equity peaks and seeing how far we've drew down from the last high equity peak. So here you can see we drew down a little bit here, but this equity peak seems to be the biggest one where we drew down from a higher peak to a lower trough. And so if you measured from there to there, on the summary page, that would give us that actual dollar amount as the maximum drawdown for this strategy. And when you're trading a strategy forward, right? This is your guide. This is what could happen as you start trading this strategy forward. So it gives us a measure of what the potential risk is as we start trading this forward.
Right. Very good. Very good explanation. And it also, that could be out of the gate, right? If you know that the maximum drawdown is X thousand or X hundred or whatever your scale is, then that could set your risk for the beginning of the trade, the start of your trading a system, right? You could have a situation where you have, like Mike was talking about, number of consecutive losses. You could have 4 consecutive losses, and if that exceeds your max drawdown on the test, it might be time to look for another strategy. But if it's underneath that max drawdown, maybe that gives you some confidence to put that 5th trade on that you might have been scared to put on earlier.
Remember that, when you're looking at a strategy like this, we're looking back from February until now, so 7, 8, 9 months. In order for you to realize this kind of performance as you trade forward, you have to trade this strategy for 9 months in order for this to play out into the future. And you never know where you're going to start out when you start trading this forward. You could start out anywhere on this equity curve. You might start here at the trough and have a great run up, or you might start trading at the top of one of these peaks and have an immediate drawdown. So you have to be prepared for entering at any point on this equity curve, and you have to be prepared to follow through on every trade that this strategy gives you over the next 9 months in order to duplicate the performance that you see here in the chart.
Right. I think it's very important to know past performance is definitely not indicative of future results, right? Just because we tested over the last 9 months or the last 9 years, the next 9 months or next 9 years could be much different, right? And so even though we have all this great data and great back testing, we just have to realize that the market isn't something we can predict to a decimal point. So we have to just realize that these statistics will help us in case the strategy does go a little awry. You can still trade your way out of something, especially if you know something like the max drawdown.
So, to Tom's point earlier about robustness, this is why we test on different time windows and different amounts of historical data to try to find a result that is as robust as we can make it moving forward. Tom, I'm going to go back to the summary tab and let's talk a little bit about some of the risk measures here. We talked about max drawdown, but let's talk about on a trade by trade risk measure, which is maximum adverse excursion.
Right. So think of max drawdown as maybe the biggest move where it went against you. It could be multiple trades. Max average excursion is basically how much a trade can move against you, right? So we look at do we see drawdown on this screen? Yes.
Max drawdown is here near the top.
So you see,
and then maximum adverse excursion is down here at the bottom. That
should always be bigger than the maximum average excursion, and it is. So the max drawdown is 8,600. Here the MAE, or maximum adverse excursion, is 2,700. That's one trade. So that might be another gauge to say, you know what? I know the max drawdown is this, but I also know the biggest loser in my strategy testing was 2743. So I'm going to use that number rather than the max drawdown on any given trade. And that could be a long trade or a short trade, right? Now, if I want to find out what it is, really the long side is 2,500 and the short side is 2,900. So it's the average of those two. So if I'm long, I have kind of a different level for the max I might lose on a trade, 2,570. If I lose more than that, I should probably get out of my position. And if I'm short, 2,900 is kind of the maximum on the downside. If I get close to that, I might close my short there.
So one of the things you can do with maximum adverse excursion is play with stop losses at that level.
Mhm.
So at 2743, or let's just take the long trades at 2570. If I had a stop loss in this strategy, let's say at 2600, just below that, that means that there could be a trade or two that would have turned around and maybe come back and either lost less or maybe even became profitable. But it also means that now my stop loss is more than my adverse excursion, and I'm probably going to change that adverse excursion number to whatever my stop loss is, because we're going to hit that at least once, right? So that becomes your stop loss, and that becomes the maximum adverse excursion. But you can play with those numbers and see whether it stops more trades out or less trades out around that number.
Yeah, that's a great point. That's a great point. There's some other stats here. I just, they're more interesting, kind of time related, average time in the market, average number of trades per day. Well, that's good for intraday trading. But when we talk about a daily chart, it really means how many, if you invert it, it's how many days in between trades on average. So looking at that, it's about 8 days between trades. Max time to recover, 11 days. So you have some time-based, if you're curious to know, okay, when can I get back in, or when should I get back in? Also, we have up top, we have Sharpe ratio, which is a way to compare, again, another way to compare strategies. It's risk reward ratio type information. And it's just basically saying how well does this strategy perform against just kind of a standard rate of return over some standard deviation? And basically you're looking for something that's greater than one. I believe greater than one, like 1.25 is considered kind of pretty average.
Yeah, I agree. And again, this strategy is just a very simple reversing strategy. We're not trying to refine the exits here. So yeah, the risk profile here is not as good as it could be if we just started adding some additional risk management exits to this strategy.
Right.
So Tom, we are out of time. This session has gone by super fast, but I think this has been a really good foundational coverage of the strategy performance report and how you and I kind of view the way to look at the evaluation of a trading strategy. Next time, we will be looking at optimization using the market analyzer. So now we're going to actually kind of delve into refining the strategy, making the performance better incrementally as we adjust inputs, we adjust time frames, symbols, those kinds of things. So that'll be a good session as well.
Right. And we'll see that reflected in this sheet, right? In the summary sheet, in some of the other sheets. Hopefully the optimization will give us better results than what we see here. I'm pretty sure it will. But that's really where you're going to do a lot of work in optimization if you're serious about backtesting.
Strategies, I've always said, is an exercise in incremental changes and incremental improvements. And optimization is a way for us to show you how to do that.
Yep, completely agree, Mike.
Thanks, everybody, for joining us. I hope you're enjoying our strategy trading series. You can send us an email at learn@ninjatrader.com if you have any questions. Otherwise, we'll see you next time. Thanks, everybody, for joining. Okay, we are back. In this segment, we are picking up where we left off in our strategy, trading, and development course. I'm joined by my colleague, Tom Snyder, CMT. Tom, thanks for being here.
Mike, my pleasure. How you doing?
Good, good, good. So in this segment, well, let's do a little recap. In the last segment, we talked about the strategy performance report. We were working with a built-in sample strategy that comes with NinjaTrader, which is a moving average cross strategy. But the next step, once you have a strategy, once you've looked at the performance, the next step in the evolution of that strategy is to try to refine the strategy using the process of automation. And that's what we're going to talk about today.
Right, exactly. I think, the progression we've had so far is a natural progression of how to improve ourselves as traders. And we've gotten to the point, to me, which is really the meat or a lot of the work in backtesting, which is not, it's funny, it's not backtesting, but it's the optimization of backtesting. So maybe we can just get right into the chart and do a little bit of recap of the strategy we've been looking at.
Absolutely. And during this session, we'll talk a little bit about what optimization actually is, how to do it in the platform, what it can do for you and what it can't do for you, and some best practices, maybe some pitfalls to avoid. So take it away, Tom.
So what you're looking at here is a modified version of the sample strategy that you'll find in your NinjaTrader platform. If you have a chart up, you can right click and you'll notice you might be familiar with adding indicators. Well, right underneath there is something called strategies. Excuse me. And you get 4 sample strategies. I have not explored creating new ones yet. I know Mike's a little more prolific with that. But the second item is the moving average. MA stands for moving average crossover study. Now I've already added it and I've changed the defaults. Looking at 3 and 10 as the moving average periods rather than I think the 10 and 25 that are there. I've already added it. But one key thing here, Mike, and you really turned me on to this, is once it's added, you won't see anything on the chart until you hit this enabled button. So make sure that when you add a strategy, whether it's a sample or your own, you want to make sure it's enabled, and that kind of locks in all the parameters so that there's no mistaking what you see on the chart. Once you hit OK, you'll see what I see, which is not only the particulars of the study, the 3-period moving average and the 10-period, but also as if we had traded using those indicators to trade, where we would have gone long and would have gone short.
Yeah, there's a couple of things I just want to point out here. So think of a strategy as a way to test an idea historically. And then once you have that strategy refined the way that you want it, you can trade that strategy moving forward with strategy automation. That'll be the next topic in this series. But just to be clear, the red line that you see, the little redded dash line, that's the 3-bar moving average. And the blue line there is the 10. And when the red crosses above the blue, we go long on the next bar at market. And when it crosses below, we go short on the next bar at market. And the strategy reverses long and short. And we can look at the performance of that historically.
Right. And that's the great thing. If we go to our control panel up at the top, I have mine at the top. You can go to new and you can pass most of the items at the top. About 2/3 of the way down, you'll see strategy analyzer. And this is key to what we're going to talk about today.
So, in the chart by itself, you can do the back test, you can look at the performance report, but when you get to the point where you want to refine the strategy, and what we're talking about today is optimization, the strategy analyzer is the window and the tool for us that allows us to do that.
So when you first pull that up, it's not reflecting what's on your chart. We need to change some of these settings to reflect what we saw. So the first thing is I want to make sure I choose the right strategy. Here it's the sample moving average crossover. But remember we talked about changing the lengths of the moving average. So I'm going to change the fast length to 3. Fast always is the smaller number. Now we'll talk about that when we talk about optimization. But generally the fast moving average is a smaller period moving average, and the slow, it takes a little bit longer to calculate, is the bigger number here. Now, the other thing we want to look at is the type. By default, it pulls up a minute chart. We want a daily chart. That's what we're optimizing on. We're looking at results from a daily time period. I believe the rest of this we can leave untouched. This date range, though, we'll come back to that when we talk about optimization practices. So I'm going to hit run. Now we don't say, okay, we're actually running this because it's going to, well, the one thing I missed, we need to select an instrument. I skipped right over that. And I'm going to use the E-mini S&P December contract. And when I hit run, it takes those parameters, the 3-period moving average and the 10-period, and trades the next bar after it crosses either up or down, stop and reverse. And had we done that using those parameters, here are the results.
So here, we look at all trades, long trades, and short trades. So you can see how the long trades did by themselves, how the short trades did by themselves, and then what the cumulative performance is. And there's a number of key performance measures. And again, we talked about this in the last session, how to interpret this performance report. But I think a picture is always worth 1,000 words. If we click in the drop down in the upper left, we can look at an equity curve here on analysis. Yes. I think that's right. There you go. And so here we can see the profitability of the strategy over time. This is kind of what we want to see. We want to see it building profits over time. Certainly, there's going to be some drawdowns. This strategy is in its, it is in a very basic form where it's just reversing. We don't have any money management exits or any other filters. So we're just getting the raw performance of this particular idea. But with optimization, we can do some refinement and try to make this performance better.
The way I look at this is we're evaluating, are these good signals? We're not talking about, like Mike said, trading the strategy with all the risk management and all the profit targets, other ways to get out of the strategy. This is evaluating these 2 moving averages as signals. And the question that comes up when we see these results, let's go back to the summary, because the top line, I think, is one quick way to see if this is something I want to pursue. And it's, is this profitable? And right now it says all trades, if you take all the trades for the beginning of the year using these rules, we would be up 17,000 and some odd change. Now, of course, we're not trading this real time. This is all looking back at history. So things may be a little different. If we had actually traded it, there's slippage, etc. But what the question that comes up, Mike, to me is, can we do better, right? Are these, 3 and 10, those are somewhat arbitrary, right? We might have a good idea about the 3-period and the 10-period, but are there better for this market? And so the thought is,
and it's interesting, just real quick here. And when you say better, by the way, Tom doesn't just mean the top line, bottom line net profit number. He's talking about a combination of performance measures that reduce risk, possibly, that improve the percent profitability. So there's a number of performance factors that we're going to look at when we optimize. Yes, we want it to make more money if possible, but I'll tell you, I would take less profit if there was less risk, or it was more profitable more of the time. So there's a number of moving pieces here that we're going to look at.
right, everything should be should fit within your risk profile, of course, number one. What I can do with this analysis is I can rename this tab. Let's just rename this real quick. And I'm going to call this ES for the symbol. I'm going to call this 310 for the 2 moving averages, and we'll call this 2024 for the year. This is just kind of how I think of things in terms of optimization or backtesting. You need 3 things, right? You need a symbol, you need some set of parameters, and you need a date range. Now, I simplified it to 2024 because it's the beginning of the year, but it helps me for future comparison. And what I can also do, I'm going to hit apply. And now we've changed that tab. The reason is because I want to compare. And so Mike and I were talking, well, maybe the 10-period moving average isn't what we need. Maybe it's a 20. So what I can do is I can duplicate this tab, and it says duplicating will force us to rerun, and that's fine. It doesn't cost us anything. It'll quickly run. And now I'm going to change that slow period moving average to a 20, and we'll rerun it. And I'm going to rename this just for clarity's sake, so I know what I'm looking at when I'm looking at tabs. I'm just going to change that 10 to a 20. It's purely a label. It doesn't change any of my results. It's just for me. But now I have another window, another summary result that I can compare. And right away, just from memory, I see that profitability, just one measure on all trades, went down by almost half. And I can confirm that by just flipping to the other tab. We were at 17,000 plus. Now we're at 9,200 plus. Profitability went down. And that might shape the way I look at this strategy and say, this isn't maybe the right way to do this. But there's a better way to do it. Mike, you could probably explain.
So what I see here is that the first thing that jumps out is that we have less trades, right? We had 20 trades on the first one. We only have 8 trades here. So to compare apples to apples, I think a better performance measure might be the average trade, Tom, which is 1,160 here. What is it on the 310? So that's 886. So the average profit per trade actually went up on the 320. It's just that we have fewer trades. So this is a good example of why we do this kind of work, is because we want to compare different performance measures and try to get to a solution that is best, like Tom said, for our risk profile.
And you can look at these trades as we divide them into long trades and short trades, see what happens to those as well. And just remember, we've been in a bullish environment for almost 2 years. So I would focus more on the long trades than the short trades, but you can focus on those as well, see the changes. But this gets very tedious, Mike.
Correct. So there's a way to automate trying to find which parameters are best for our strategy. And that's just by changing the backtest type from backtest to optimization.
So what I'm going to do is I'm going to duplicate this tab again. And it pops over here. It says Analyzer. Over here in the top right, it says Backtest Type. We can go to Optimization. And this gives us some other things to think about. When we run this optimization, it's going to perform a heavier analysis. It's going to do many backtesting analyses at almost, consecutively really fast. So the question is, what do we change? And there are a couple things you can change when we talk about optimization. You can talk about the settings of the studies, right? The moving average periods. That's the most obvious, I think, for me. But you can also test on different time frames. So we're testing on a daily. Maybe you want to test on a 4-hour chart or a 5-minute chart. You can test on a different date range. So we give that capability. Right now, we're testing on the same date range, but maybe I want to, and this is key to optimization, I think we'll talk about in a little bit, is you definitely want to test it over different time ranges to see if you get consistent results. We'll talk about that in a moment. And then you can also test over different symbols, but you have to be prepared. You probably will get different results, and it only really matters if you're testing or trading in those symbols that you run the test on. So I think to start, Mike, what we'll do is we'll think of a range. And we'll think of a range for the slow period moving average or the slow moving average, and a range for the fast moving average. So we were using 3 and 10. We tried 3 and 20. What do you think are acceptable ranges for that slow moving average, Mike?
So I think for the slow moving average, we can keep it at 10 and maybe move it out to 20. I think that's a good range.
Okay.
And we can, and again, now it's the increment, right? The increment is, do you look at 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, or do you set it to 2 and look at 10, 12, 14, 16, 18? So I think for this test, we should leave it at 1 so that we look at every possible solution. And then
I agree.
And then on the fast, we don't want the fast to overlap the slow. So in this case, I would go from 3, let's say, to 8 in increments of 1.
Now we're using very small ranges, and that's why I think it's good to use the increment of 1. But if you decided to boil the ocean and you said, I want to use 2 to 200 for both parameters, then Mike, I think we would either do 2 or 5 or even 10 to see how we would have done, because odds are you probably won't trade something like a 47 versus a 169 moving average, right?
And by doing that, you can then zoom in on those parameters that most affect the performance, and a smaller range that you can then kind of delve into.
Exactly. So very key to know that these 3 numbers, it's interesting. If you didn't know, why do I all of a sudden have 3 numbers separated by these semicolons? Well, it's the first 2 are the range, and the third, very key, is the increment that we look at. So everything else remains the same. We started with a daily chart from the beginning of the year to the current day, and all we need to do now, it's basically running every iteration of these increments for the fast and slow moving average.
And
And
in this case, Tom, that'll be 66 unique tests. And what's amazing about this is that for each of those 66 tests, it's going to apply the data, it's going to apply the strategy rules, it's going to create a performance report, and then it's going to summarize it for us. And the speed that it does this is just incredible.
one more thing, Mike, couple things you want to look at when we hit the optimize section. Keep the best number of results. So generally, if there are 66, I don't need to know all 66. I want to see the top 10 best results. But to your point, Mike, how do we measure best? Well, we have to tell the system what best
So
is.
I'm gonna challenge you on this, because one of the things that I do when I'm kind of delving into these smaller optimization groups is that I do want to look at all of the tests, because there's a robustness factor here. How many of those 66 tests were profitable? And so if only the top 3 out of 66 are profitable, that's not very robust. But if more of them are profitable, that could give me an indication that I don't have to be so exact in picking the right parameters. Almost any of those parameters might be good. So it's just a robustness test that I sometimes do. Again, maybe again on the larger kind of these initial optimizations, setting it to the top 10 or 20, I think is valid as well. But as I get deeper into the optimization, I want to see how many of those tests were profitable.
So let's do this. Let's keep all 66 because we can do that. The optimize on is, to your point, Mike, profit factor is probably the number one thing everybody looks at, but you do have other factors. You have a bunch of factors, right? And so we're not going to go through them all here, but you know that you can factor on, you can sort or optimize on that drawdown amount, that Sharp ratio, the profitability per trade, per long trade, per short trade, all those things you can select optimize on. We'll leave it at max profit factor and we'll just hit run. So it's going to give us a little different bit of a view. But how quick was that? 66 different iterations in about 2 seconds.
Pretty amazing.
So what it does right away is it gives us the results at the top sorted by the best result according to what we told it to optimize on. Here's the total net profit. And it tells us that, wow, okay, on the E-mini for the past year, 5 and 15 moving average periods, the 5 period crossing the 15 gave us the best results. And so, and it also tells us some of the other factors we might want to look at. So I can see right away, well, the total net profit was about 30,000. We did 38 on the profitable trades. We did 8,000 on the non-profitable trades, and our max drawdown was 5,300. So we can make judgments around that.
Exactly. And again, you'll notice that there's a highlight in that upper box there. That gray box is telling us that the performance report below is based on that parameter set. So the performance below now is showing that we can see all the different parameters there.
Right. We can go into depth into each result based on those parameters, on those moving average parameters.
The other thing is, Tom, can you, I think we can scroll to the right in the upper, is that true? I don't see a scroll bar. Can you, if you use it, if you click there, can you move to the right? I'm not sure.
Yeah, it doesn't give me much more than these 8 or 9 columns here for
And
the
that's why we
results.
have the performance below.
Exactly.
That makes perfect sense. So here, I mean, what's interesting about this is as you click down through that upper box, we can look at the short trades. And in that first one, the short trades are profitable. And if you just kind of click on the next one, the short trades are profitable. So again, at that point, they become unprofitable. Does that continue? Yeah. So one of the things, Tom, scroll down through that list in the top. There's 66 there. Just kind of show everybody that all 66 are there. And if you scroll all the way to there you go. See, there's the first one that's not profitable. So the majority of these are profitable. So that's a good sign for robustness, which means that, remember, we have to pick a set of parameters to start trading moving forward. And if only a couple of these are profitable, it kind of limits what we're going to select. But in this case, 50, 55 of these are profitable. And as time goes on and markets change, we don't have to be so exact. Whatever we pick here probably has a good chance of being profitable trading forward.
And it also shows us that we don't have just a couple of these combinations that are profitable. And so they might have caught just a random winner, right? That others didn't. You kind of have all of these, a majority of these set of parameters to some degree profitable, right? And, the next step for me would be, okay, well, if just the indicators are profitable, what happens if I add risk management to it? What if I add different ways to put an absolute stop, a trailing stop, maybe a moving profit target that might supersede what we see in the indicators? You might see some improvement in your strategy.
You certainly would see. You certainly would see improvement here. I mean, to your point earlier, here we're just kind of testing the entry. So I think we've proven that the moving average cross entry is pretty robust. Now, we can go back to that strategy, add some risk management. Maybe this is a trending strategy, maybe add a trailing stop, maybe add some filters for market bias and slowly, incrementally make this strategy better and better.
Exactly. So once you've got, so you can rename this tab. I might rename this something like E-mini 2024 OPT. I don't really need to know what the range is if I'm happy with that. If I'm not happy, I might put in the range of, or maybe first iteration. I don't really need to do all the details, but if I'm happy with it, the reason why I might want to keep the year in there, and we'll hit apply, is because the next part of optimization is let's test the same optimization over a different time period. So what I can do is I can duplicate this into a new tab. It'll rerun. That's fine. I'm not really worried about the rerunning. It shouldn't change too much. And so over here, we see the date ranges. And you could there are different ways to optimize on the date ranges. You might take 1-year slices, right? You might take 5-year slices. You might look at different regimes, what's happening with interest rates, what's happening with the overall trend. But regardless, you can pick the dates. And I'm just going to go back to 2023. I probably did this the wrong way. There's probably an easier way to do it, but we're going to start first day of 2023, and we're going to go to the last day of 2023 and optimize on that date range. Just hit run. And I might see something similar, or if it's a different kind of trend, it might be something vastly different. But I'm optimizing on the same factor. I'm using the same range, and now I have slightly different parameters, 8 and 18, but it's close to 5 and 15. And so what I can do is I can rename this one and call it ES 2023 OPT. And this is where the work might comes in with optimization. It's not always about optimizing the settings, but it's really, I think, about optimizing over different date ranges, because you want to make sure it's robust. You want to make sure that these settings that you picked in one time period are actually pretty consistent over different time periods.
And that makes perfect sense, right? Because the market is not going to behave exactly like it did in the backtest moving forward. So
Right.
you need multiple timeframes historically to be robust, to be profitable, so that you have the best chance that that strategy with those inputs that you pick have the best chance to work and be profitable moving forward.
So let's see.
Let's talk a little bit. How much time do we have here?
It's a great question. I'd
We
go
have
all
five-
day, Mike.
We have
Keep
5 minutes. So let's kind of just look through and talk through a little bit about some of the things that you can do in that right panel in the optimizations, just to kind of fill out the functionality here. If you go to that top backtesting type, there's some other optimization tools here, which are walk forward optimization. There's some other advanced optimizations there, but let's just talk a little bit about walk forward for a second. And walk forward is the ability to forward test your strategy just using historical data. So what it does is it takes a portion of the data that you're selecting in your date range. In this case, we're doing 1 year from January to December. And it takes, for example, the first 9 months of the year and it back tests on those. It picks the best parameters and then it uses those parameters on the out of sample next 3 months of data. It's kind of like forward testing it, but doing it within the back test. And it shows you whether or not those parameters hold up on a sample of that same historical data.
It's almost like seeing if those factors are consistent throughout the time period, right? Anytime you back test something or you look at a strategy and you say, wow, this is great, you run the risk of getting in a time and implementing it where you might have consecutive losers, right? And so doing the walk forward allows you to see, well, is it a consistent distribution of winners and losers, or is it front loaded because there was some event or some sort of regime going on, and maybe there was a change in direction? But that's what walking forward allows you to do, to see how consistent is this with providing the results you're looking for.
In this case, the strategy that the best result here made $46,000 in 2023, but during that time there was a $12,000 drawdown. Now that number is important for two reasons. One is it gives you the correct expectation that there is risk associated with this strategy, so that if you start trading this live with real dollars and you have a drawdown, you know that there is a risk of at least a $12,000 drawdown before the market, finally plays itself out. Can you look at real quick, Tom, the analysis again? Let's look at that $12,000 drawdown in the drop down there to show the equity curve.
Let me run that again. And then we'll go over here to the analysis.
So
this is the 3 and the 10. Now I didn't change it. We can run 5 and 15. Let me just make sure we have the right parameters. That actually gave us a nice equity curve. There we go.
So there you can see that drawdown, right? From that $14,000 peak in September all the way down almost to zero. In fact, it actually lost money. So there was a big losing trade there that drew this market down. And this goes back to what Tom and I were talking about before, is that this is just a crossing strategy. It does not have any mitigation for those kinds of large losses, which you can build into the strategy with just some risk management techniques.
Right. And drawdown is the measure of from peak to trough. What is the biggest move? Right. So this is a really good example where you were profitable almost the entire time you're in the strategy, but no one, I think, who's really paying attention would allow a trade to last this long to lose all your profitability. Your risk management would have taken you out of there. And again, the strategy we're looking at is just for the signals. You could build a strategy that builds in the risk management, and this equity curve would look much more improved, hopefully.
Exactly. Tom, we are out of time. This went by very fast, but we will explore both the performance report and optimization in upcoming segments of our strategy trading and development series. So Tom, thanks so much for being with me.
Mike, it was great. Always fun to talk to you about this, and looking forward to the next session.
Next week, we'll be talking about automation, best practices, what you need to know to start taking these strategies and trading them hands-free moving forward. Thanks everybody for being with us. We'll be back in a minute. Okay, welcome back, everybody. In this segment, we're going to discuss strategy automation as part of our strategy development and backtesting series. As I've been joined on all of these previous episodes, I'm joined today by Tom Snyder, CMT. Tom, thanks for being here.
Mike, it's my pleasure. How you doing?
Good, I'm doing good. This series has been a lot of fun to do. This will be our 5th episode. We talked about, foundations of strategy trading. We talked about the elements that go into building rules, performance evaluation, optimization, and then the ultimate expression of strategy backtesting and development is automation, and that's what we're going to talk about today.
Right. We've done a lot of work to get to where we are, and hopefully we've found something that we're okay with, that we're happy with in terms of the laboratory. But now we're actually going to put this in the real world, or at least a simulated real world, by applying the strategy to our simulated trading account.
So let's just get a couple of definitions out of the way. So strategy automation is the ability to take a back-tested set of rules and apply them to a market, and the strategy will make the entry and exit trades for you automatically hands-free. It's like program trading. It's like being one of those big guys that just lets the computer run and go. And the reason we do this is that we want to be a little more disciplined. We want to stick to our rules. We want to stick to our plan. And it really adds a new layer of discipline to your trading that can really, help you take your trading to that next level.
Right. It also helps with the emotions, right? It kind of takes the emotions out of the trading. If you don't have an automated trading system and we're trading manually, you run the risk of veering from your plan and participating or not participating based on your emotions. This takes that out of it. So for good or for bad, right, we still have to rely on our strategy as being a good strategy for what we're trying to do. Just remember that no matter how well you test a strategy, you could run into 1, 2, 3 consecutive trades that don't go your way. And that's hopefully, something that doesn't happen, but we just have to, be aware that not all trading strategies are 100%.
So that's an interesting point, because one of the things that you get from strategy backtesting a trading idea or a set of rules is you get an expectation of what the risk of that strategy is, what the performance of that strategy is. So it really kind of gives you, a way of knowing in advance a little bit what to expect in drawdown and profitability. And to your point, that can really help keep emotions in check.
So Mike, maybe let's take a look at the chart and see what we've done so far. This is the micro NASDAQ December contract in this example. It's a 1-minute chart. I know we decided to test everything on a daily basis and look at daily data, but you can also apply a strategy to an intraday chart, and of course you would want to test it to that time frame. In this case, for the purposes of education, we're applying our strategy 3-period moving average crossing the 10-period moving average to a 1-minute chart, so we can show you what those trades might look like.
I mean, if we were on a daily chart, this session would have to be several weeks long in order to see a couple of trades. So using a 1-minute chart is just for demonstration purposes only here, so we can see those crosses in real time and show you what you can expect from the automation process.
Exactly. So let's take a look. So right now you can see this looks like a strategy that we've seen before, that we've put on our chart, and it has notated where we have taken or would have taken trades, as the case may be. Now, this is a mix. What we're seeing now is a mix of history of trades that we would have taken had we had this enabled, but also we've actually taken a trade already today using this automated strategy. So when I say a mix, this is what the strategy would have done. And then once we enable it, it actually is trading. So how do we enable that, Mike?
So let me just back up one step here a little bit. So what we're doing here is we're watching the historical backtesting of the strategy now in real time. So there's two environments here that we operate in when we're automating a strategy. One is we're looking at the strategy in the chart, and it's generating orders in real time. But the chart, and this is the key part here, the chart is not generating the orders. The way that strategy automation works at NinjaTrader is that we apply that strategy to the control center, and the control center monitors the rules and places the trade. So Tom, yes, let's do that. We already have the strategy in the control. Oh, do we have it in there? Go ahead, go to strategy. So yes, we already have it in there. Do you want to remove that and add it, or do you just
Sure.
want to talk through this?
Well, let's remove it. We're about to get a nice signal, so or maybe a signal. So the way you would do this when you first open up strategy, you should not have any strategy up there, and you would just go to the first item, new strategy, and then you'll see the strategies that you may have developed, but you also have some sample strategies. I use this sample moving average crossover strategy, and here we would take the instrument that we want to apply it to, choose that instrument here. I chose the micro NASDAQ. This is by the micro E-mini because we already have a strategy on for the micro NASDAQ. And we would make sure that this reflects what chart type we're looking at, a minute chart. It's 1 minute, 1 minute. And pretty much everything else works the way we want it to. Here, we would want to make sure our parameters are set to that automated or that back-tested strategy. But if you've saved that back-tested strategy or that optimized strategy as its own strategy, then those should already be filled out. We hit OK. And now I've got two strategies working. I have one that we see on the chart here, which is the NASDAQ, but I'm also watching it here in the E-mini. Now I have not enabled it. This is the key. You can add a strategy to that strategy panel, but until you enable it, it's just sitting there waiting to work. It isn't active.
Tom, can we go back to that edit dialog?
Sure.
There's a drop down there that I just want to talk about for just a second here. And if you scroll down a little bit, it says calculate. So it shows the account that you're trading in, and then it calculates. So let's click on calculate for just a second there. So the strategy that you have in the chart, it evaluates the rules based on a cadence that you set here. Now, the strategy can either calculate just one time per bar, evaluate the rules, and then generate orders, or it can evaluate the strategy on every tick, in which case, if once the rules are true, it will immediately send the orders intra-bar as they occur, or on a price change, which is very similar to each tick. If the price changes and the rules are true, then the strategy will generate those orders the moment that those rules are true. In this case, we're using on-bar close because we want to make sure that the two moving averages have crossed on the close of the bar, and then we generate orders into the next bar.
Oh, that's a very good point, Mike. If you use each tick or price change, you run the risk of crossing those moving averages during the bar formation, getting long or short, but then by the end of the bar, the pricing might reverse and uncross, and now you're in a position where you didn't want to be according to your strategy. So very key when we're talking about crossing events, we want to make sure that we use bar close. So let me
Click cancel there.
click that out. And now what we're looking at again is that mixture of historical data, historical trades. We really didn't trade here. This was applied to the chart, but once we enabled, which was back here, and we'll look at how you can tell, this is now trading according to those rules. And in a moving average crossover, if you don't have any other type of exit, you're always in the market. You're either long or short. So each one of these events creates an exit order that gets executed to close out your previous position. And then it does the same type of order to go the other direction. It's a stop and reverse study. So you'll see two different types of orders. You'll close your position and then you'll either sell short or buy. And that is because you're opening a new position. So it'll show you which on top you'll see the one that closes out the position, and then underneath the next order, which will open that opposite position. And so you can see here, when we see these moving averages cross, this 3-period crosses above the 10, we wait for that close to confirm, and then we go long that next bar, because this bar was closed and it confirmed. We see the moving averages continue to travel up as the market moved up. We have a little bit of consolidation. It allows the 10 to catch up to the 3, a small pullback. And we see right here, we saw a cross occur. We waited for the close, and then we went short. And then we also, we closed our long position, we went short, and then a quick reverse. This is a whipsaw. That happens in moving average crossovers. We went the opposite way, and now we're long one. And you can see this reflected in my order where I got in, right? This is a one lot that is green, so it's long, and I'm underwater right now because we're trading right below that price.
So Tom, do you need to have chart trading turned on to see that little indication of long and short?
Exactly. So the way I have my chart trader on, you can go up to the top of your chart. You see this egg beater on the side. You have off, chart trader, and chart trader hidden. I like to have that chart trader hidden just as a rule when I'm manually trading, but it'll also show if you have your chart trader on with the ticket on the window. If you turn this off, that indication that you're in a position on the chart disappears. And I can turn it back on by going back to the egg beater and either choosing chart trader, but I like the hidden. It gives me more room on the chart.
So as I said earlier, there's two things going on here, right? There is the automation that's occurring in the control center, and then there's the monitoring of the strategy in the chart, right? So if we go up to the control center, Tom, we can actually monitor whether or not the position that the strategy in matches the position that we are in the real world. So that's really an important point here, is that for the strategy to close a position or take a new position, they need to be in sync. So the real world position has to be in sync with the strategy position. And in this case, it's our real world position is a simulated environment, but it's the same concept. So maybe talk a little bit about those columns in the control center there.
Right. So the first 4 columns are informational: what strategy, what instrument, the data series, a 1-minute chart, and the parameters for the studies. That's something that we would change if we edit the strategy. Here, this is where Mike's talking about what position does the strategy say that we're in. We're in a 1 long position for the micro NASDAQ. It's kind of, if if it didn't know that we were trading this, if it wasn't automated, it still would show a one long position because that's what the chart says. Now the account position is one long as well, right? We took a long position when this trade executed, and so they match, so they're in sync. Now, if you're not in sync, you can right click and you can synchronize the strategies, and that'll kind of correct this. But sometimes you'll say the sync is false. You'll see the sync is false, and that's when you'd invoke that. We just have some other informational columns here. Average price. So average price is if you had multiple units. Some strategies you can enter one unit, let's say one contract, and then add to that strategy. It's kind of layering in or pyramiding in a strategy. So the average price would take all the entry prices and average those out. Of course, here's the P&L, so to speak, right? Unrealized. This is the current positions P&L, and then this is the P&L of the positions we've taken and closed up until now. The account that I'm in, and then of course my data connection, and is it enabled? So that's basically a summary of those columns. But the key here is we want the position. If you're trading this live, you're trading this automated, you want this position to match the account position, and if they are, they'll be in sync.
Click on the positions tab for me there, Tom. This is where you can get a quick look to see what your actual position is in the simulator, or if you're trading with real dollars in a real account. This is where you can see that position. A couple of best practices here, Tom. One of the things you don't want to do when you're automating a symbol is to trade it in another strategy or to trade it discretionarily through the chart trader or the Superdome. If you're automating a strategy, in this case we're automating the MNQ, you do not want to be trading that anywhere else. That's a real important best practices, because anything you do in that on this symbol other than the strategy is going to mess with your sync. So you're going to mess up that sync, and the strategy is not going to be able to do what it's supposed to do.
Right.
So Tom, we just had a trade. Notice we went from long to short here.
Exactly. So
let's look at that strategy tab again real quick.
Let's go back to strategies.
And now you can see we're one short.
One short. They're in sync.
One short in our account, and we're in sync. So that's what a live strategy trading fill looks like.
These lines
completely hands-free.
Right. Yeah, I should keep my hands above here.
Nothing up your sleeve.
Let the trade happen. You know what's really neat about the way this is displayed is there's a connecting line between the trades. So every time we take a trade, there's a dotted line, and sometimes it looks like it's one line with two different colors, but it's just the different trades. Sometimes they don't go the way you want, and the trend stays the same. But we color those according to if they're profitable or not. So this long trade was a nice profit, but this short trade kept going. So we got stopped out. And we didn't get stopped out. We got chopped out. We got chopped out because the moving averages reversed, and we took a losing trade there. And now we're with this what was this? This was a long trade that again also got a little bit choppy, and we took another losing trade when we got out. And so now we're short, and we're hoping that current trend that was not good when we were long remains now that we're short. So these connecting lines on the strategy, we really haven't talked about them, but they're a quick way to say, okay, where was I profitable? Where was I not profitable with my trading?
Yeah, that makes perfect sense. Yeah, they basically draw a line from entry to exit, from entry to exit. Yeah. Let's talk about another best practices, Tom, and that is when you're automating a strategy like this, and especially if you've got some experience with it, there could be a tendency to want to just let this run, grab your golf clubs and go play golf while this is running and it's making money for you while you're playing golf. That sounds great, but in practice, Tom, anything can go wrong here. You could lose internet, you could lose power. There could be the strategy may have a bug in it that you didn't know about until it manifests itself in the chart. So you really need to be present here, even though this is going to free up your emotions. It's going to improve your discipline. It's going to give you time to work on other things while you're monitoring your strategy. But this isn't something where you can just set this and forget it.
Oh, completely agree. I mean, you said it the best, as if the internet goes out, which is kind of what everybody relies on when we're talking about trading. That alone should give you pause for thinking about walking away from your screen. But you're right. You want to make sure that where the execution is happening, meaning when it's happening and at what price, and are your trades looking the way you envisioned? You can actually apply the strategy without enabling it, so it's not turned on, and you can look at the history to say, okay, I back tested this, and I can get a good sense that yes, these executions in the past that would have gone off here look correct. But I would also just, that doesn't give me a reason to walk away. I want to make sure that they're correct as they're being executed, because you don't know. There might be something that is between the data provider and you. There might be something that causes this not to behave the way you want it. Of course, internet outage is the number one thing that would make me concerned, but there might be other things. So you do want to monitor and say, is this automation behaving the way I want to? And it could be a matter of programming too, right? So, there are all sorts of things you want to think about, but ultimately, you want to make sure this is behaving.
So, there's a lot of things going on in a strategy. It could generate market orders or limit orders, and how those orders behave in real time can be a little bit different than how they behave historically. Historically, you don't have the fast market tick by tick behavior. So it's really important to, once you backtest something, as Tom said, to forward test it. You don't have to forward test it with automation. You can forward test it, make sure everything is being generated like you expected. Once you have that confidence, then you can automate it in the simulator. Once you have confidence that that's working, you can automate this with your real dollar account with the smallest possible size to start, and then you build yourself up from there once you build confidence in the strategy.
Completely agree. Mike, now one of the things you can do to check, right? We can visually check what's happening, but there's another tab in the control panel, and it's called executions. So this will show you, if you go to executions, these are the orders that are executed across your account. Now you have these different columns, and you have the actions, buys and sells, you have the quantities, all this information. I've sorted mine on time. Here's the time column, just to show what's the latest execution. Kind of makes sense, right? If we're questioning what's happening on the chart, oh, does that look right? That recent trade, I want to see that at the top. So I've sorted on time. And basically, I can look at my chart and see, does what happened on the chart match what happened in my executions? And so I'm looking and I see, well, the last two executions were sells, right, in the micro NASDAQ. And we would kind of expect two of the same trade when we're doing a stop and reverse. So looking at this, at just a little bit ago, we got two sells, which jibes with what I did here. And I can scroll down. There's a scroll bar on the right, and I can just continue to slightly scroll down and make sure that this makes sense. Now, you may run into, if you have an account that you trade other contracts in, you may run into another contract, right? And that's okay. You could sort by instrument as well, but you just have to be aware that this control panel shows all the activity, all the executions you've done in this account, not just what's on the chart. But it's a good way to make sure that, look, I don't know if this went off. Let's make sure it did. Oh, it is in the executions tab.
Yeah, that is a good point. If you look at the name column there for a reversing strategy like this on the executions tab, the name column to the right. There you go. This shows you exactly the order entry behavior that each order generated. So it closed a position, it took a short position, it took a long position. You can see that here. And that is a great column to kind of track what's happened in the account and what's happened in the strategy. So, again, there's lots of different data information here that can really help you.
Mike, I do want to remind everybody that this is for educational purposes only. These factors are not optimized. We don't recommend them for intraday or historical or to automate trades in any way. This is just to show you what you can do. We looked for you to determine what's best for you, but realize this tool is available for you to help you be a more disciplined trader.
I agree. So, Tom, one last thing before we go. Let's go back to the strategies tab. And, let's say I'm done strategy trading this for the day.
Yes.
How do I stop it, and how do I get flat?
So the first thing I would do is uncheck enabled. Notice that I still have my position, but the strategy came off of the chart telling me that it's not active. Really, the key though, Mike, is it has to be in this panel because this is what drives that automation of routing orders to the exchange. To your point about getting flat, you can come
just
over.
One thing real quick. Notice
Yes.
that the position column does not have a position now. So the strategy does not have a position. That's really important to note here. But the account does have a position, and that's what we've got to get rid of.
So the quickest way I like to do it is go over to positions. And if you only have one position, you can use flatten everything. That'll close everything that you have, every order. If you're walking away from your NinjaTrader and you're done for the day, I highly recommend coming here. And if you have a position, flatten everything. If you want to keep the position overnight, that's a different story. Now, if you have multiple positions and you do want to keep one of them or multiple positions, but you want to close this one, you can just hit close position and it'll take care of just the instrument you have highlighted. And so now it closes that position and I can walk away without worrying about having any orders left in the micro NASDAQ.
Perfect. So, Tom, we are out of time. This concludes our foundational strategy trading and backtesting series. There are 5 videos. You can find those videos on YouTube, and you can find those videos in the your client dashboard on the Learn page. And so this has been a lot of fun. What's coming up next is we're going to start doing some deep dives into particular strategy setups, key reversals, opening range breakouts. There's a lot of different things that we can explore and determine and test whether that is a robust entry strategy for a particular market at a particular interval. That work is what I'm looking forward to. That'll be fun.
Once you get familiar with how backtesting operates within the NinjaTrader system, like you said, it gets to be the fun part of backtesting where you can explore your ideas. And we've got a lot of them.
We certainly do. Thanks, Tom, for joining me today.
Mike, it's always my pleasure. This has been a fun series.
Thanks, everybody, for joining us. Make sure you go back and watch some of the other videos. And we'll be right back with Midday Wrap Up. Thanks, everybody.
The following presentation is for educational purposes only. All the symbols, trading ideas, and market commentary are for educational and demonstrational purposes only and are not recommendations or trading advice. Live sample trading occurs in a simulated environment. Past performance may not be indicative of future results. All the information and content presented is provided by NinjaTrader LLC, and the opinions expressed by all third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involves substantial risk and may not be suitable for everyone, and trading futures can result result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.